How do you spot volatility skew? If you are curious about how to identify volatility skew in options trading, you are in the right spot. Understanding this concept can help you make better trading decisions. So, how do you spot volatility skew? First, let's talk about implied volatility. Implied volatility reflects the market's expectations regarding future volatility of the underlying asset. It varies with different strike prices and expiration dates. To start spotting volatility skew, gather implied volatility data for options that share the same expiration but have different strike prices. You can then plot this data. On a graph, place implied volatility on the vertical axis and strike prices on the horizontal axis. This visual representation will help you see the shape of the volatility curve. Next, look at the shape of this curve. A volatility smile appears as a U-shaped curve. In this case, both deep into money options and out of the money options have higher implied volatility compared to at the money options. On the other hand, a volatility skew, often called a smirk, is an asymmetric curve. This means that implied volatility is higher on one side of the strike prices. For instance, if out-of-the-money puts have higher implied volatility than out-of-the-money calls, this indicates a negative skew. This often reflects demand for downside protection. Another step is to compare implied volatility across different option types. Check the differences between in-the-money, at-the-money, and out-of-the-money options. If out-of-the-money puts have higher implied volatility than out-of-the-money calls, this is common in equity markets. It usually indicates fear of downside risk. Conversely, if out-of-the-money calls have higher implied volatility, it suggests a positive skew, possibly due to expectations of upward movements. You should also examine skew by expiration dates. Volatility skew can change across different expiration dates. To do this, plot implied volatility across expirations for the same strike price. This will show how market expectations evolve over time. Traders often use risk reversals to quantify skew. Risk reversals measure the difference in implied volatility between a call option and a put option that have the same delta. A positive risk reversal indicates higher implied volatility for calls, while a negative one indicates higher implied volatility for puts. Interpreting market sentiment is also key. A steep negative skew, where out-of-the-money puts have higher implied volatility, signals increased demand for downside protection and bearish sentiment. A flatter or positive skew may indicate bullish expectations or less fear of sharp declines. Lastly, keep an eye on changes over time. Volatility skew is dynamic and can shift with market conditions, news, or events. Monitoring its evolution helps you adjust your trading strategies accordingly. In practice, spotting and using volatility skew can guide your trading strategies. For example, you might buy cheaper at the money puts when out-of-the-money puts are expensive due to skew. Understanding skew also aids in risk management, as it reflects perceived risk asymmetry in the market. By analyzing implied volatility across strike prices and expirations, recognizing the shape and direction of the skew, and interpreting what it reveals about market expectations, you can gain a clearer picture of volatility skew in options trading.